In an era where the word unprecedented has become tediously common, the recent spikes in mortgage interest rates in the United States have revitalized its use in financial circles with a sense of alarm. In what some analysts are calling a mortgage meltdown, rates have ascended to levels not seen in decades, casting long shadows over the American dream of homeownership and shaking the pillars of the broader economy. This surge is more than a mere fluctuation. It is a seismic shift that beckons a deeper understanding of its roots and ramifications. The interconnection between mortgages, the quintessential conduit to property ownership, and interest rates is intricate and potent. As rates spiral, the ripple effects are manifold, impacting not just potential home buyers, but also echoing through sectors as diverse as construction and retail. This essay delves into these turbulent waters, navigating the complex interplay of economic forces at play and scrutinizing their broader implications. The trajectory of mortgage interest rates over the last few decades has been largely characterized by relative stability, followed by a low-rate environment fostered by Federal Reserve policies post-2008 financial crisis. However, recent shifts have been dramatic, with rates more than doubling in a short span, reflecting broader economic shifts and policy responses to inflationary pressures. The graph above illustrates the volatile journey of mortgage rates from the stability of the early 2000s to the sharp upticks observed in recent months. This escalation is partly a correction from historically low levels, but also a reaction to inflationary pressures not seen in over 40 years. This sharp increase could be contextualized as a necessary dampener on an overheated housing market. Yet the speed and scale of the adjustments have caught many by surprise, leading to a re-evaluation of buying timelines for millions of Americans. The immediate effect of rising mortgage rates is a direct hit to affordability. High rates increase the monthly repayment amounts for new mortgages, which shrinks the buyer pool and cools down overheated markets. However, this cooling often translates into reduced home ownership rates, as fewer individuals can meet the financial criteria required to secure a mortgage. The above graph underscores the decline in first-time home buyers, a critical segment that typically drives market vitality. This decline not only affects potential homeowners, but also has broader societal impacts, contributing to generational wealth gaps and economic disparities. Moreover, the increase in rates has pushed existing homeowners to hold onto low-rate mortgages, reducing the available housing stock and exacerbating market tightness. Interest rates are a fundamental tool used by central banks to control monetary policy. By adjusting these rates, the Federal Reserve aims to curb inflation by controlling spending and borrowing. In the context of mortgages, higher interest rates mean higher borrowing costs, which can cool down an overheated housing market. This infographic explains how Federal Reserve decisions impact mortgage rates. The Fed's recent rate hikes are a preventive strategy aimed at staving off inflation, but these moves also harbor the risk of slowing economic growth excessively, potentially leading towards a recession. The economic theories of supply and demand, as well as Keynesian economic principles about how interest rates influence consumer behavior, are crucial to understanding the current scenario. While the housing market feels the direct impact of interest rate increases, the effects ripple outward to other sectors. Construction, home improvement retailers, and furniture sectors, for example, all feel the pinch as fewer homes are built and sold. The chart reflects the downturn in construction starts, a direct consequence of reduced housing market activity. This downturn not only affects those directly employed in construction, but also has a cascading effect on industries reliant on new home construction, such as building materials and home furnishings. Simultaneously, the slowing of these sectors can lead to broader economic slowdowns, highlighting the interconnectedness of modern economies. The sharp rise in interest rates has not gone unnoticed by policymakers, who are in a precarious position of balancing inflation control with economic growth. The government and monetary authorities are deploying a range of tools, from rate adjustments to more targeted interventions like subsidies for first-time home buyers or support for affordable housing projects. The diagram above delineates various government initiatives aimed at mitigating the impact of high mortgage rates on housing affordability. These include tax incentives for home buyers, grants, and potentially capped interest rates for certain segments of the market. The effectiveness of these interventions, however, is subject to debate. Critics argue that while they may provide short-term relief, they do not address underlying issues such as supply constraints and could lead to distortions in the housing market. Conversely, proponents believe these measures are necessary to prevent a sharp decline in homeownership rates and to stabilize the housing market. As the dust begins to settle, the focus shifts to the future trajectories of mortgage rates and the housing market. Analysts are divided. Some forecast continued high rates as inflationary pressures persist, while others predict a stabilization or slight decline as the economy adjusts to the new norms. This graph represents various expert predictions on the direction of mortgage rates in the upcoming years. Such projections are crucial for potential home buyers, investors, and policymakers as they plan for the future. Market sentiment, meanwhile, is cautiously pessimistic. The memory of the sudden rate hikes lingers, instilling a sense of caution among buyers and investors. This sentiment, if pervasive, could slow down the recovery of the housing market even if rates stabilize at lower levels. In an increasingly interconnected world, U.S. mortgage rates and the housing market are not isolated phenomena. Global economic shifts, such as changes in foreign investment patterns, international trade policies, and economic conditions abroad, also play significant roles. The map illustrates key regions that have historically invested heavily in the U.S. housing market. Changes in these regions' economic policies or their own domestic economic conditions can have ripple effects on the U.S. market. For instance, a recession in Europe or tightened credit conditions in Asia could reduce the amount of foreign capital flowing into the U.S. real estate, further complicating the market dynamics. The mortgage meltdown induced by skyrocketing interest rates is more than a temporary anomaly. It is a recalibration of the financial landscape that will have long-lasting effects on the U.S. economy. The journey ahead for the housing market, prospective homeowners, and economic policymakers is fraught with challenges and uncertainties. As we navigate this new normal, the interplay of domestic policy measures, global economic trends, and market sentiments will dictate the pace and nature of recovery. It is imperative for stakeholders to remain vigilant, adaptive, and informed to manage this complex, evolving scenario effectively. In conclusion, while the sharp rise in mortgage rates poses significant challenges, it also offers an opportunity to address long-standing issues in housing affordability and market stability. The path forward will require a balanced approach, blending economic prudence with innovative policy interventions. This comprehensive exploration underscores the pivotal role of mortgage rates in the broader economic landscape and highlights the multifaceted responses required to stabilize and steer the housing market towards a sustainable future.